Take a one-person landscaping company. First month in business just closed. The books say the month's profit came to $4,900, while the bank account holds just $4,000. And the cash generated by actually doing business? Negative $1,000. Same company, same month, and every number is correct.
Hold on, how are all three of those true at once?
Every one of them. Same books, same month. That's accounting, the system that turns everything a business does into 3 reports, each answering its own question. If you've ever heard profitable company runs out of money and thought that sounds impossible, this is the mechanism behind it.
And people bet real things on these numbers. Jobs, savings, whether a business can make rent. That's the risk. Imagine this owner reads $4,900 of profit as spendable cash and schedules a bill for that amount. The bank holds only $4,000, so the payment comes up $900 short.
Yeah, so here's the plan. One tiny company, 1 month, 6 transactions, followed through all 3 reports. The backbone matches the beginner's guide from the SEC, the U.S. markets regulator, and the sources are linked in the description. By the end, you'll know what each report is actually asking, which means the disagreement stops being a riddle and becomes the clue.
So let's name what accounting actually is, because it's not a scoreboard with one number on it. It turns events, a sale, a rent payment, a printer purchase, for example, into named categories, then rolls those up into a few standard reports.
The reports being the 3 we just met?
3 that will follow, plus a 4th worth naming up front. The SEC's official set also includes a statement of shareholders' equity. It shows how the owner's stake changed during the period. The balance sheet shows where that stake ended, so the big 3 can carry our story.
Fair. So what actually separates the 3? Why not one report?
Time, first and foremost. The balance sheet is a photo. One date, freeze the frame, what the company owns and owes at that instant. The income statement and the cash report are the month's video footage.
Same month, 2 different cameras.
Exactly. One camera tracks value earned and used up. The other only tracks cash actually moving.
And I'd bet most people assume the 3 reports are just 3 ways of calculating the same number.
They're not the same. They disagree by design. So the disagreement is information, not an error. Our landscaping company is about to prove it.
All right. Let's build this company from 0. Day 1, transaction 1. The owner moves $10,000 of her own savings into the business bank account. Accounting records that as 2 things at once. The company's cash balance becomes $10,000, and the owner now holds a $10,000 claim on the company.
Hang on. Imagine watching that account jump from 0 to 10,000. On paper, the best day this company will ever have. So why isn't it profit?
Because nobody earned anything yet. No client, no service delivered. The cash is an asset, accounting's word for something valuable the company controls. The owner's claim is called equity, the owner's slice of the company, whatever's left after everyone else gets paid. Profit only enters the story when the business actually does business.
So each dollar sitting in that account is also a dollar somebody, somewhere, has a claim on.
You just said the entire balance sheet in one sentence. The formal version, assets equal liabilities plus equity, liabilities being what's owed to outsiders. Not a formula to memorize, bookkeeping honesty. Resources on one side, whose they are on the other.
And I'm guessing that first deposit gets a label on the cash side too?
It does, and it pays off later. Cash that arrives as funding from the owner, not from customers, gets tagged as financing activity on the cash report. The result is a day 1 split you can already see. Fat bank account, nothing earned. Cash first, earnings later. Different tracks from the very start.
So the company's sitting on $10,000 of owner money. Time to spend some. Transaction 2, $5,000 in cash for equipment. A commercial mower, a trailer to haul it. And here's where a lot of us get it flat wrong. The instinct says the month just took a $5,000 hit.
It didn't?
Not on the earnings side. On the books, total assets haven't fallen at that instant. Cash drops $5,000, equipment appears at $5,000. That recorded amount simply changed shape. And long-lived purchases like this can be recorded as assets instead of instant expenses. The exact rules depend on the situation, but that's the core idea. An asset carries value into future periods. An expense records value used up in the current one. The gear will help earn money for years, not just this month.
Okay, but my first thought is cash left, so the company must be poorer. 5,000 actual dollars left the account. Somewhere that has to count, no?
It counts twice in two different places. The cash flow report shows it immediately, in full, investing activity, cash spent on long-lived stuff. The income statement counts it slowly through something called depreciation, spreading the gear's cost across its years of use.
So the purchase hits the cash camera in full on day one and the earnings camera in installments.
Exactly. For example, our company records just $100 worth this month, a deliberately simplified slice. That's the honest picture, not a trick. The mower doesn't evaporate the day you pay for it.
Now here's where it gets really interesting. Transaction 3, the company finishes a full season opening cleanup and pruning job for an office park and sends an invoice for $8,000, due a month from now. No cash arrives, nothing touches the account, and this is still the biggest financial event of the month.
Wait, really? The biggest with nothing hitting the bank?
The biggest, because the work is done, delivered, invoiced, finished. That's the whole logic of accrual accounting. Record economic activity when it's earned or incurred instead of waiting for cash to move. The income statement books $8,000 of revenue now, and the balance sheet gains a new asset, accounts receivable. Plain English, customer money earned but not collected yet.
I'll be honest, I didn't realize how completely I'd fused "we made money" with "money arrived." They're just not the same event.
Same for almost everybody. Cash feels like the truth. But think about what that invoice really is. An enforceable claim on the $8,000 earned by finished work. If the books hit it, they'd be lying in the other direction, pretending a delivered project never happened.
And the trap cuts the other way, too. For example, a bakery that sells everything on credit can post record profit and still struggle to make payroll before the customer's cash arrives.
Exactly. The nightmare version of reading profit as cash.
One flag worth planting, though. It's not that mailing any invoice equals revenue, right?
Right. Under U.S. accounting rules, written by the Financial Accounting Standards Board, or FASB, revenue depends on whether you delivered what you promised. Our landscaper finished the job, so it counts now. Let's say the company invoices a half-done job instead. The revenue may not count yet. A sale and a cash receipt remain separate events. The result is two diverging storylines. Earnings up, bank flat.
After that $8,000 IOU, transactions 4 and 5 feel almost easy, mirror images of each other. First, rent. $1,000 paid in cash. Cash down $1,000, expenses up $1,000. An expense being resources used up this period.
The rare event where both cameras agree at the same moment.
It really is. Next, the mirror. A freelance contractor finished $2,000 worth of work this month, and she gets paid next month. No cash has moved, and accounting books the expense anyway, the full $2,000, and a new balance sheet line called accounts payable. Plain English? Money the company owes but hasn't paid yet.
Hold on, though. If no cash moved for the client invoice or for the contractor bill, what makes either one belong to this month at all?
The work happened this month. The project delivered, the contractor's hours logged. Accrual accounting splits two questions that feel like one. When did the work happen? And when does the cash settle? The income statement runs on the first. The cash report only ever sees the second.
So the receivable and the payable are twins pointing in opposite directions. Value earned, collection pending. Cost incurred, payment pending.
That's it exactly. And look at the month's shape so far. A ton of business, barely any cash movement. An $8,000 IOU inbound, a $2,000 IOU outbound, one rent check. That gives the income statement nearly everything it needs. One tiny entry to go.
So it's time for the first report card. 6 transactions in. Well, 5 so far. The last entry is the one we set up at the equipment purchase, the $100 depreciation slice. With the set complete, the income statement answers its one question. Did the period earn more value than it used up?
All right, show me where that 4,900 is hiding.
Now, revenue, 8,000, the finished project. Expenses, 1,000 of rent, 2,000 of contractor work, 100 of depreciation, 3,100 in total. Subtract, and you're left with $4,900 of profit.
So that's the headline. But say precisely what it means, because this is exactly where people overread.
Sure. Measured by work delivered and resources consumed, the month created that much new value. And that's all it claims. It's not a pile of cash sitting anywhere. Most of that revenue is still an IOU inside the receivable.
Profit tells us what the month earned. Now let's ask where the cash went.
Next comes the bank balance, and explaining it is the cash flow statement's whole job. It sorts every dollar that physically moved into 3 buckets. Plain language first, cash from ordinary business activity, cash from long-lived asset moves, and cash from whoever funds the company. The official names? Operating, investing, and financing.
And our month only had 3 cash moves in total, right? Rent out, equipment out, owner money in.
That's the whole list. Operating first. The rent alone, negative 1,000. Neither IOU shows up here. Not the clients, not the contractors, not a dollar moved yet. And this report is strictly the account's diary. Then investing. The equipment, negative 5,000. Finally, financing. The owner's 10,000 coming in. Sum the 3 buckets, and you land at positive 4,000. Started from 0, so that's exactly what the bank is holding.
Okay, so hold the 2 headlines side by side. 4,900 earned, and day-to-day operations drained 1,000 from the till. We built every piece, and it's still jarring.
Which is why accountants keep a standard bridge between the two. It's worth walking across once, step by step. Start where the income statement left off, 4,900. Add back the depreciation, 100, a real expense, but no cash left the building for it, bringing the bridge to 5,000. Subtract what's parked in the receivable, the full 8,000, and you're at negative 3,000. Add back in the payables, 2,000, cost counted, cash still ours, and you land on negative 1,000. Exactly. The 2 reports don't just coexist, they reconcile, line by line.
Here's the honest pushback. Imagine a small business owner looking at this and saying, if cash is what keeps the lights on, why not skip the income statement entirely and just watch the account?
Because cash can't tell you where it came from. This bank balance looks great, $4,000, and every cent of it is the owner's own money. Ordinary operations lost cash. For instance, selling the trailer would also raise cash. So would a loan.
So the cash report tells you whether the company has money available to pay what's due, while the income statement asks whether this month's revenue exceeded this month's costs.
Don't force them to match. With both period reports settled, now we can see whether the whole story hangs together.
And the check is the closing photo. End of month, the balance sheet freezes the frame, and every number in it should trace back to something we watched happen. Assets first. Cash, 4,000, just explained dollar for dollar by the cash report.
Cash is the first asset. What else is still sitting there?
Accounts receivable, 8,000, still uncollected from the client. Equipment, 5,000. Less the 100 allocated to this month leaves 4,900. In plain English, that's money in the bank, money the customer owes, and the gear's remaining book value, the value still carried in the accounting records. Together, the assets total 16,900.
And the other side of the photo, the claims.
Liabilities, the 2,000 owed to the contractor. Then, equity, her original 10,000 plus 4,900 more. Look familiar?
So the income statement's profit has now increased equity inside the balance sheet.
That's the connection tying the month's results to the ending snapshot. Kept profit belongs to the owners, so it grows their claim. And nobody took a payout here, so all of it stays. 2,000 plus 14,900, 16,900 on both sides to the dollar.
Man, that's satisfying. And the matching isn't decorative, right? It's doing real work?
It's the consistency check on the entire story. Every resource has a matching claim, and the month's video ends on exactly this photo.
And if the sides didn't match?
Then the entries need investigation. Balancing catches some recording mistakes. It proves only that the equation adds up, not that every entry is correct or that the business is healthy. That sets up the last piece. Naming the habit that kept it all in sync.
So one habit is left to name, the thing that kept every entry in sync. Each transaction we recorded changed at least two things, always in a way that kept the equation balanced. That's double entry. Accountants track the two sides with the words debit and credit. You don't need their direction tables today, just the idea that every entry has to balance.
So the machinery under centuries of bookkeeping is record each event across multiple accounts and keep the sides equal? That's it?
That's the core mechanical rule, not the judgment accountants make, but the control underneath the reports. One stream of transactions feeds the named accounts, then the accounts roll up into those three views. A mismatch exposes a broken connection.
Which hands you, honestly, 3 useful questions for any business claim you'll hear.
Okay, hit me.
Say someone tells you, we had a great year. First, what happened to profit? Then, what happened to cash? And last, what does the company own and owe now? If the 3 answers hang together, you've at least checked whether the claim is internally consistent.
And if nobody can connect them?
Then you've just learned what a missing connection looks like.
One boundary before we close. A real analyst reads more than we did. That fourth statement, the footnotes, the policies behind the numbers. What you have now is the map all of those details hang on.
And the riddle we opened on quietly dissolves. Profit, 4,900. Bank, 4,000. Operating cash, negative 1,000. 3 honest answers to 3 different questions.
Once you know which question each report answers, profit, operating cash, and equity stop competing. And business news, business pitches, even a friend's new venture start reading like one connected story. Thanks for listening to Learning Podcasts.